Well, welcome back to the Undervalued Investor YouTube channel. Today, stocks are getting absolutely devastated this week, unlike anything we've seen pretty much over the last couple months. And this is all thanks to the recent Federal Reserve meeting. We're going to break down some of the data, the recent articles, and we'll take a look at some stocks as well. If that's a conversation you'd appreciate, hit that like button, because getting into it, the Federal Reserve held its interest rates steady in a decision released Wednesday, while also indicating it still expects one more hike before the end of the year and fewer cuts than previously indicated next year. That final increase, if realized, would do it for the cycle according to projections the central bank released at the end of its two-day meeting. If the Fed goes ahead with the move, it would make a full dozen hikes since policy tightening began in 2022. Markets had fully priced in no move at this meeting, which kept the Fed funds rate in target range between 5.25 and 5.5%, the highest in some 22 years. The rate fixes what banks charge each other for overnight lending, but also spills over into many other forms of consumer debt. While the no hike was expected, there was considerable uncertainty over where the the rate setting Federal Open Market Committee would go from here. Judging from the documents released Wednesday, the bias appears toward more restrictive policy and higher for longer approach to interest rates. So let's break some of this down with, first and foremost, the Fed, Jerome Powell stated that the GDP should come in for the fiscal 2023 above 2%, which again does kind of put us in line with what could potentially be a soft landing. A lot of people are calling for a recession, which technically we hit a technical recession back in the midst of 2022, because a technical recession is 2 consecutive quarters of negative GDP, which we recovered from fairly quickly. And this is kind of more broadening our horizons toward a more hopeful future. But what's kind of really, sinking in the stomachs of investors right now is this massive spike in month-over-month inflation that came in basically through August, right? And this was pretty devastating, though mostly a self-inflicted wound, because higher interest rates, led to higher shelter costs, which was one of the defining factors, along with gasoline prices. Gas seems to be volatile, goes up, it comes down, and that's a huge defining factor to a lot of this. So it's no surprise the Fed took a little bit of a pause just to see how shelter costs and everything else continue to bake in into the next month or two. But taking a look at how the market has been digesting this, because with them saying that they're going to leave rates higher for longer, when most people are anticipating cuts as early as spring of next year, that's really going to put a lot of strain on growth potential. Obviously, a lot of infrastructure and debt these companies have, especially when you look at everything from real estate investment trusts to industrial based companies to the telecom giants. They're all heavy debted. Same with a lot of banks and their lending practices when it comes to loan loss provisions. So the market is kind of pricing in that the growth vector coming into next year is going to be pretty low. And taking a look at the S&P 500, I mean, this week alone is down 3%. Palantir, some of the hardest hit stocks are being in the AI sector right now. Palantir dropped over 10% this week. PayPal's down about 8.5%. Nvidia's down another 8%, and Amazon's down 8.2%. What was most intriguing about a lot of these stocks is they posted pretty nice EPS growth over last quarter. And if that continues into the future, it's likely these could be very good potential buying opportunities. And the Fed putting a little bit more strain on the market is just opening up a window of opportunity for you, presuming we do have a soft landing. This is a great place to cost average, and you should hope that this kind of window stays open for longer, because when we go back in time, these price points are far and few in between, considering a lot of these stocks have pretty much driven up dramatically from the the 2023 lows here. So maybe I doubt we get back to the pandemic levels we experienced, but I would take any dip as an opportunity for the time being. But I'll pass the question off to you. I'd love to know what you think about that in the comment section below.